This one's going to be a tough one to hear. I hate to break it to you, but there's nothing special about dividend investing. In fact, it blinds you. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Gold investors, bonjour. Mike Leroux here. I am with my co-host Véronique, and today we do not have good news. I mean, it's going to be a tough podcast to listen, but please bear with us till the end, because if not, I mean, you're just like, if you just spend like 10 seconds and read the podcast title, that's not going to work it. Right, Vero?
Yeah, I mean, the title is like, it seems very weird from the Dividend Guy blog podcast, because if you didn't notice, it's Dividend Investing Blinds You. But I mean, like Mike said, stay with us, listeners, because you really need to hear this.
Yeah, I mean, it's a major problem that I've addressed many times, but not like this. Today, we're going to look a little bit more about the reason behind the fact that dividend investing could blind you and could push you to make the bad decisions, and to more going to do the deep dive into the understanding, because I
Mhm.
had that feeling that sometimes investors think that the stock market is crazy, there's no justification for stock price, and the dividend comes by magic into their bank account. So we're just going to set some facts straight, I would put it that way. And I guess that since I'm a passionate dividend growth investor, it adds up to the credibility that I'm not completely blinded by the dividend. So
Okay, so Mike, the idea for this episode started with the question, is it possible to live off dividends only? But then we realized we couldn't answer that without explaining the problem with dividend investing. But first, what does it mean to live off dividends only? And what kind of portfolio would that imply?
So, by definition, when you start reading about dividend investing, you probably think, oh, I'm going to invest so much money that after that, my portfolio is going to generate so much dividend that I will protect kind of like my capital because I will never touch it and I will just live off those dividends, which is amazing. And it makes even more sense because throughout our entire life, we work, we get a paycheck. So once you stop working, you're gonna want to replicate this paycheck system. So having a portfolio, and even sometimes we do have requests about, oh, Mike, can you look at companies that pays quarterly but on a specific cycle with like dividend payments in April, because in
Mhm.
reality we don't really care for a full year or for the next 10 years when you get the money. But I definitely get that if 1 month you get $10,000 in dividend and the following one you get 1,000, it's not replicating that paycheck sentiment that just comes in all the time, or replicating the pension idea of getting the same amount during the same month and just rolling with your budget. So you buy an asset, you want to get paid, you want to protect your capital. So I would call that, you like to do napkin calculation. So you don't need like something fancy or an Excel spreadsheet. You invest $1 million, you want $50,000 a year. So you generate 5% out of that. And once you die in like 35 years, you still have $1 million to give to your estate, which is kind of like the perfect situation, right?
Mhm. And then there's also the 4% rule for retirement withdrawals. What is it exactly?
So already, when you're thinking about that napkin calculation at 5%, it gets in conflict with that rule of thumb that if you want to have a safe retirement plan, you should not touch more than 4% of your capital each year. So the 4% retirement rule was like came from studies made by William Benjamin in the 90s. And the idea was to study the stock market, study the fluctuation, and making sure to build a withdrawal plan that would go through most situation without depleting the portfolio too fast, and to at least have for 30 years worth of retirement. As we mentioned last episode last week during our fire movement, if you retire at 50, you're going to be short if you just plan on 30 years of retirement. But then again, that's another story. So the idea is to be able to withdraw 4% per year plus inflation. So it was also factored there. Unfortunately, it is a rule of thumb. It's not perfect, and it has some major flaws. The first one is it counts on a static withdrawal rate. It means that if you have $1 million today, you're set to withdraw $40,000 on the first year of retirement. After 10 years of retirement, it's still $40,000 plus inflation. So the buying power doesn't change. But in reality, in your first years of retirement, chances are you're going to spend a little bit more. You'll be healthier, more active. Maybe you will do more activities or travel more, or want to share the wealth with your children or grandchildren, help them out. So in other words, you may be spending more in the first 10 to 15 years of your retirement, and then slowing down the road. So the 4% is pretty strict for that. It's really just the same number for the next 30 years. So if you play around that numbers for a few years, it's going to not work, and you may end up depleting your portfolio too fast. The second biggest problem is the fact that it was based on US expected return assumptions. So if you're Canadian or if you're living in another country, maybe you're not going to have that luxury of benefiting from the one of the most prolific stock market and most diversified that is in the US. It's also based on an asset allocation of 60% stocks, 40% bonds. So the classic balanced portfolio, which is good, but it's just that if you are not willing to take on market fluctuation, and you do not want to have 60% of your money invested in stocks, it's not going to work out. Like
Right.
if you're at like 50 or 40 or 30% and you want something super stable, then it also means that it will affect your expected return. And do not forget, I had that discussion with another client of mine. If you focused on fixed income, it means that you're going to generate more interest income, and interest income outside of tax sheltered accounts, they are fully taxable. So your expected return is less, and chances are you're going to pay more in taxes than if you get a mix of capital gains, dividend, and interest as well. Finally, 30 years may not be the perfect time frame to plan for retirement. So when I do my own financial projections, I still plan to have money until I am 100. So if I die before, good news, I have money to give to my estate. But if I plan to live up the age of 82 and I live until 92, the last 10 years is going to be a pain. And I don't necessarily want that either. So yes, the 4% is a good guideline. And in most cases, if you just don't want to go into that deep of a process, you can use it. But just be aware that there are a few flaws. So even if your portfolio will generate 4% in yield, maybe it's not going to be enough going forward.
All right, so all this leads many investors to seek 5, 6, 7, 8, sometimes like 2-digit percent yield dividend stocks. However, there's a problem with that, and it starts by understanding why a company pays a high yield.
Yeah, I did not want to go the classic route that, oh, if you invest in a high yielding stock, it because it's riskier, it because it has risk or anything. But I wanted to focus today on the mechanic, the reason why a company pays a high yield versus a low yield. Because there's no free lunch in finance, and there is a reason why a company offers a 1% yield versus 3 versus 7, or as you said, versus like 20%. I had so many requests to review Zim Integrated. The ticker was ZIM. I think it was in 2021. So it was a few years ago, because it was a marine shipping company, and it was offering some kind of like a crazy yield like this, like 20%. And everybody was like, oh my God, that's like the next Klondike. It's amazing. The stock price was going up and the yield was crazy. And yet there was a reason, because it didn't last long, and unfortunately, and I'm pretty sure I burst a lot of bubbles when I did that answer and then I did that review. But I told people, I'm like, If you plan on retiring on that stock, you're going to be very disappointed. And the only direction is the dividend is not sustainable. And eventually the stock price will not maintain this popularity. So this is what we're going to do today. We're going to dig a little bit deeper, trying to find those answers and not stay in the cliche that, oh, high yield are risky. They're just reasons that you must understand.
So there's a direct link between a stock's price and its yield. So the higher the price, the lower the yield, and the lower the price, the higher the yield, right?
Yeah, it's quite simple, right? But this is how it works. We have to start at the beginning. So if there are no interest for a stock, it means that investors are not rushing to buy it. So simple economic rules of offer and demand. There's no demand for the stock price will drop, and then eventually the yield will go up. So if you're thinking that, imagine a stock price at 100 paying a 5% dividend, and the dividend doesn't change. So it offers a 5% yield. A few years later, still paying 5% in dividend, but now the stock price trades at 80 bucks. So the yield becomes 6.25. And then it would become 8.3%, such an amazing deal, because the stock price decreased to 60 bucks. So it's really just it's a function of the stock price versus the dividend. On the other side, taking the same example with 100 bucks invested, 5% yield. If the 5%, if the $5 becomes $6, there's a 20% dividend increase. But if the stock price went from 100 to 200, your yield went down to 3%. However, I would argue that it's a pretty better investment, this one, than the other one, even though one is paying now 8.3% and the other one is paying 3%. So kind of crazy, but yes, the 3% yield is a lot better. So the question that you have to ask yourself is why there is such a strong demand for the second stock that I talk about and not for stock A? Because there is a reason there why investors are rushing to buy the second company that eventually pushed the price from 100 to 200. And in general, a stock, when you think about that, a company or even an investment, it could be like an ETF or whatever, it will attract more investors for literally two reasons. The first one is if the company is making more money. So we're thinking about a company growing their sales, growing their profit, growing their cash flow. So grow, grow, grow. I mean, it's just normal that you pay a higher price. If you
Right.
look at a company like Procter and Gamble, very stable, selling like a lot of like household products. Well, the PE, so the price to earnings ratio is usually between 23 to 28. So that means that the investors are willing to pay 23 times to 28 times the earnings. So the stock price in the past 10 years, so no dividend, just the stock price, just went up by about 83% in the past 10 years. While if you look at the earnings per share, they went up by 76%. So almost 83, very close to that 83%. In other words, because Procter and Gamble made more profit per share, it's only normal that you have to pay a higher price today. In reality, you pay about the same valuation that you would have paid 10 years ago, all things equal and the same. But since the business is making more money today, the price goes up. So that explains why it's going up, because the company's doing well. The other reason why a stock price would go up and attract investors would be if there's a lot of expectation from the market. So we could call this a hype. So the market could be wrong, the market could be right, but it's always looking forward. So a company like in the AI industry could be attracting a lot of investors right now. The stock price could go up. And this may be why it creates so much confusion from investors thinking, well, there's no justification for that company to go up right now. Yes, it's true they're not making more money, but the market thinks it will in the future. So you have to make the difference first when you look at a stock. Is it because of real numbers? So make a company making more profit, then it's just normal that the stock price goes higher versus a company that is making not enough profit or slowing down. Well, then the stock price will probably go sideways. So the point here is to understand that the only thing that will attract investor is either more profit today or the promise of more profit in the future. But when you're looking at a stock that is struggling, well, this is why investors are not interested, because they're just, I don't see the point here. There's no growth vectors, so I'm just going to leave and go elsewhere.
Mike, after all these years helping investors and retirees, we found a way to create a dividend income for life, and you will share this in our upcoming public webinar. So let's pause the episode a bit and invite you, listeners, to this special event. We will hold a live webinar on Thursday, November 28th at 1 p.m. Eastern Time. What will attendees learn, Mike?
Well, first, as a dividend investor, you just want to live off your dividend and enjoy your retirement. That's the ultimate dream. However, there is a big problem with dividend investing, and a lot of investors are blinded by the yield. So we're going to talk about that. We're going to tackle the dividend myth. And I'm also going to offer you a different way to see how you can structure your portfolio with high quality company that will not fail you. And there you can still create that dividend from your portfolio. This is why we call it dividend income for life. We did that webinar last year to celebrate our 10 years anniversary at DSR. We had over 2,000 investors that watched that webinar. So I'm expecting a lot of questions for the Q&A. It's going to be a lot of fun. So I want to see you there on November 28th. And of course, if you register and you cannot attend, you will receive the replay.
So like you said, Mike, after the presentation, we will stay around for a 1-hour Q&A session. This is your chance to ask Mike your questions and get straight answers. Of course, the webinar comes with some freebies and I'll be in the chat to assist you. So save your spot now for the live session or to get the free replay at thedividendguyblog.com/webinar. Again, Thursday, November 28th at 1 p.m. Eastern Time. Create a dividend income for life at thedividendguyblog.com/webinar. All right, so Mike, let's look at the other side of the scope. So if, like you've said, a stock price is low and its dividend yield is high, it means the demand for this stock is also low. So what qualities would such a company have then?
So then we're going for the opposite answer to that question of like why there is a strong demand. It's like why there's no demand. Well, when you're thinking first, probably a mature business, a business that is less exciting. And that could make sense for a lot of investors that goes for like stability. They just don't necessarily want to have the stock price to skyrocket, but they want to have like something stable. So that is the beginning of higher yield. But most of the time, we're going to start at like around like 3-4% and eventually go above 5%. And for the sake of this episode, and most of the time, I would qualify a high yield something about higher than 5%, especially right now. But you need to draw a line. I mean, you can argue all the time. At 4, I would say it's a good yield, but at 5, it starts to get high. So then, if it's not a mature business, it will be a struggling one. It will be a business that has a very hard time to find growth. So not being able to grow their sales, not being able to grow their profit, short on cash flow. And then investors will have to focus a little bit more and do a little bit more digging. But on the other side, what they usually do is, oh, well, I have a very interesting investment narrative around this one. My investment thesis is very strong. And you're going to tell yourself the good old story that, oh, it's a REIT. Everybody needs a property to live somewhere or a property to have their business. Everybody has to eat somewhere. Everybody needs a phone. Everybody needs natural gas and power. So, of course, all those companies are great. I mean, this is a good starting story. I'm not saying it's the opposite. It's a good starting point, but you have to ask yourself, the numbers, are they matching that story? And here's a pretty good example. When was the last time that you took an airplane?
Oh my God, it's been a couple of years.
Okay, so you went to Ireland. Oh no, you went to Morocco like a few years ago, right?
Yeah, 2 years ago. Yeah.
Yeah, so there you go. Okay, so was the airport filled with people?
Yes.
Yeah, and when you took the airplane, I mean, was there like half of it was empty or it was like pretty much full?
It was full.
Yeah, it was full, right?
Right.
I travel every single year, and every single time it's really rare. Actually, I don't remember the last time I was able to take 2 or 3 seats and then just go for a nap. I mean, it's usually pretty much full. So we, based on that, based on the fact that airports are filled with people, it's always crazy to get there. There's plenty of traffic. You get to the airport, there's still plenty of people everywhere. You get to the plane, there's plenty of people in the plane. And yet, when I look at airline companies as a stock, like as an investment, they suck like so much. They're bad. It's hard because, and then you're thinking, well, everybody travels. Like the airplanes are always flying. There's no like stopping this, and it's not a declining business,
Hmm.
but very rare they will pay a dividend. Almost impossible they will be a dividend grower for several years, mostly because there are so many different factors that will influence that business that makes it not an amazing business to grow cash flow on a
Hmm.
steady basis. There are like the fuel charges that goes up, and it's hard. They are seen as a commodity, so people don't really care what they fly with. They just care how much they pay, so they want to go for the cheapest price. The margin is thin, it's capital intensive. There are like plenty of reasons why it's not that great of a business model, even though everybody likes to fly from time to time, and every time I take the plane it's full. So it's
Hmm.
not enough to have a good story. You also have to look at numbers. So you have to ask yourself, do I want a company that is not making more profit year over year in my portfolio? Do I want a company that is not able to grow their sales? Do I want a company that is struggling to pay down their debt? I mean, I don't care about the yield right now. If I answered no to those 3 questions, I don't care about the yield. I just don't want that company in my portfolio. And instead of telling you it's all going to be okay, uh, you should do more digging. And I did that for BCE a few months ago. And then a lot of investors said, "Well, Mike, you did that work for nothing because BCE sold some assets and it's all good now." And I'm like, "Yeah, what they sold and what they're going to get in 23 after taxes and everything, they will likely just compensate for how much they get into debt, more debt in 2024. So they're just bringing back their situation for about 1 year before, like around end of 23, and the situation hasn't changed and the business is still not growing, and the expectation of like revenue growth is like 2%. So the problem is intact even though they sold some assets, and the problem is still intact even though everybody needs a phone. It's not the problem. It's not because people watch TV or needs a phone or whatever that BCE is an amazing business. The reason why it offers a high yield is because investors sees that there's very difficult growth potential there, very limited expectation of growth, cash flow is short, and the expenses keeps on going up. So forget about Bell, forget about its yield. Just focus about, would you like to invest in a company that at best will grow at 2% its sales, but will not grow its earnings and will not grow its cash flow because they have to reinvest all of their money plus some more debt into their business just to keep on going? That doesn't sound like a very interesting investment, right? But
Right.
that's pretty much what's happening right now. So they really need, and it's not over for BCE. I just want to be clear there, but they really need to work very hard to shift that company around because right now it's not looking good. So they, like, as long as they pay a dividend and it's not cut, there's still hope, but it's going to be a tough ride for management. I would not like to be in their shoes right now because I would see a lot of problems and not so many solutions.
Okay, so again, investors need to wonder if that's what they want to rely on for income. But some would argue that the price of a stock is not guaranteed and can go down anytime. However, the same applies to the yield. So the yield and dividend payments are not guaranteed either, right?
Yeah, so if we go back to our explanation, the stock price in general will increase if the company makes more profit. If it makes more profit, it will likely be able to at least maintain its dividend, likely to be able to increase it.
Mm-hmm.
On the other side, well, it's the opposite, right? So when you think about that, the stock price is not guaranteed. That is true. But a stock price that is declining is often a sign that there's a lot of things that is not going that well with the business. And therefore, the dividend is even less safe. So when you're comparing two companies and then you look at a business that offers a 7% yield versus one that is offering a 1% yield, chances are the 1% yield has great metrics and a robust balance sheet, and the other one has limited growth vectors, struggling a little bit, and it's going to be hard for the business to increase its dividend. So down the road, which type of company has the most chances to see their stock price decline? Probably the one that is struggling already. And then I'm taking aside all the market crisis, because in the market crisis all stocks are going to go down. So that applies to the low yield high growth stocks with great balance sheet and robust dividend triangle and all the metrics you can add to that. But it also applies to all the high yield struggling companies. And usually during market crisis, you're going to see a lot of dividend cutters, and most of them will be announced by those high yield companies, not the one that had a thriving business before.
Mm-hmm.
And when the market goes up, like right now, we're almost always trading at a all-time high. We don't really see the problem because everybody gets the money they need. So you need more money. That's not a problem. There's a strong appetite on the bond market. So investors are willing to pay to buy those bonds. They're willing to buy those preferred shares. Everybody's happy and all stock prices go up. I mean, I often like to say a monkey would have made money in 2024. So I'm no different than the monkey. I made money, but it's not just me, it's just everybody. But on the other side, when things are tighter and when there's no more appetite for additional debt, and then that debt costs so much, then those high yielders will face more problem. And when you make that difference in your mind, you understand that the stock price is just a function of how well the company is doing.
Right.
And the dividend is also a function of how well the company is doing. So if you do not focus on quality companies, you're opening yourself to some serious damage to your portfolio.
Let's take a quick pause to invite listeners to download the DSR Recession Proof Portfolio Workbook. This guide will empower you as an investor so you can stop doubting your decision and invest with more conviction. What type of tools will they get, Mike?
Well, actually, I created this workbook in 2020 during the pandemic crash to help my members to cut the noise and invest with more conviction. It was a tough period and a lot of investors had a lot of questions. It's a workbook, not a book. It means that there's plenty of questions over there to help you evolve as an investor. And every year I'm upgrading it, adding pages, adding content, and make it more complete. So when you know the answer, you don't stress about the question. And this is how you can invest with more conviction.
The DSR Recession Proof Portfolio Workbook is totally free. Visit thedividendguyblog.com/workbook and download it now. If you already used it, hit the comments and let us know how did it help you. Again, thedividendguyblog.com/workbook. Okay, but Mike, still, I need to play the devil's advocate for a while. If the dividend yield is not guaranteed and the total return is not guaranteed, why do you consider a low yield, high growth stock safer? At that point, I mean, I could just take the easy solution and go for the high yield, right?
Yeah, take the money and run. I mean, that makes sense. I mean, when you're thinking about this, you're just like, okay, nothing is guaranteed. And you have on the one side, you can get 7% return with that dividend that is guaranteed type of thing. And on the other side is at 1 or 2%. Yeah, I get that. 7% seems very interesting. But now going back to why there is a difference. Well, one company is thriving, the other one is struggling. Which one do you want in your portfolio? So in general, I am completely indifferent to the yield. It's not even part of my investment analysis Because sometimes I will find amazing companies and they will pay a 4% yield or even sometimes 5. I mean, sometimes the market doesn't see it clearly, and that's fine too. And you will have opportunities. So it's not true that a high yield is automatically a garbage stock. That is not
Mm-hmm.
true at all. It's just a huge warning sign. And usually, with that warning sign, you will look at the dividend increases. And most of the time, those high yields struggle to increase their dividend. So that's a second warning sign. And then you're going to look at financial metrics such as a payout ratio that will be typically high for a high yielding stock that does not increase its dividend. So a third warning sign. And then when you look at the revenue growth, the revenue perspective, the earnings per share, same thing, they will not be impressive. At best, they will be stable. But in the business, when you don't grow, you die, especially for the long run. Because, I mean, your expenses are going to keep growing, right? Like, even if I just bring it down to dividend stocks rock, if I don't grow, if I don't acquire more members and I don't make more money, I mean, each year you get a pay raise. Each year I have to pay more for my license for Refinitiv and Y charts and all the other service that I do. And each year, the inflation itself is going to kill my business at term. So I have to find ways to grow the business. Well, if it's true for a small business, it is true for a big one as well.
Mm-hmm.
So
Mm-hmm.
therefore, you want to either focus on the quality of the business and forget about the yield. So you get a business that you understand how it like the business model and what are the potential growth and what are the potential risks. You go with a robust set of metrics that will fit within what you're looking for. So depending on people, on my side, I like to have companies with steady revenue growth, steady earnings growth, and steady dividend growth. But that could be other metrics. But you just have to not rely on a great story and combine both. If you just have the yield and you decide to get blinded by this and you don't do any research just for the sake of receiving a paycheck, it's not gonna be worth it, because at one point or another you're gonna buy an AT&T, you're gonna buy a Walgreen, you're gonna buy an Algonquin, and you're gonna buy like all of those bad stocks, and it's going to be ugly in your portfolio.
Mm-hmm. And if you want to have like some ideas of those bad stories, we did an Halloween episode on investing horror stories and zombie companies. So you can go in the show notes and I'll put the link to that episode. Now, Mike, during our investors' life, there will probably be a time where we will hit a market correction or a recession. And many think that focusing on returns can put someone's retirement income at risk. Do you agree, and why?
Yeah, definitely. And it's usually one of like the biggest argument from those that focuses on high yield. They just say, well, what happens if your low yield portfolio goes down? Because in a bad market, everything's going to go down, as I mentioned before. But it's an illusion of safety. Here's the thing: you have a job, so you're thinking, oh, I have a job, so if we get into a recession, I'm good. The business owner will suffer, but I do have a job, so I'm all good. But then when you start thinking, who pays my paycheck? Oh, it's the business owner. So if the business owner is struggling, maybe I'm going to struggle too. And the
Mhm.
dividend is the same. So thinking that you can go through a market crisis with high yielders and keep your dividend intact, wow, that's not going to happen. And we saw that so many times in 2018 when the market dropped after such a great ride after the financial crisis. It was a year recently that saw the most dividend cutters. And of course,
Mm.
I'm not looking at the COVID because that was just like a crazy year with everything inside. But 2018 was just a classic bear market, like 20% down, a lot of bad narratives, and a ton load of companies cutting their dividend. That I know that was like 6 years ago, but still it happened. And most of those companies, of course, they were high yield. Now, on the other side, if you go for a lower yield that doesn't cover your expense, that is also a problem. And I totally agree. The argument is valid. If I invest $1 million, I need $50,000 a year, and I generate 25,000 in dividend. well, I need to find the money elsewhere.
Mm-hmm.
And
Mm-hmm.
the answer of selling shares while the market is down, that means that my $1 million is not a million anymore. It's probably like more like $800,000. I don't want to sell shares during a bad time. So yes, that makes sense that, yeah, it's not protected. So the solution for that is to have a cash reserve, or also known as a cash wedge. So if you have money on the side to cover for the gap between what you want to withdraw and how much you generate in income from your portfolio, you are not forced to sell during the market downturns. You can wait for 1-2 years. On average, a classic bear market will take about 18 to 24 months to recover. So if you have two, I would say probably 3 years is probably better, just to cover for the big crisis, such as the financial crisis of 2008 and the tech bubble of 2000. Those crisis took more 4 to 5 years to recover. So you want to be on the
Mm-hmm.
safe side, but having some cash on the side. So you take the cash, you take your dividend, you don't have to sell any shares, and you let your portfolio recover smoothly. That will be a lot better because the companies in your portfolio will be healthy, will have a robust balance sheet, and will be able to survive the crisis without cutting their dividend and without taking 10 years to recover. Because even if you look at what's happening with the high yield before COVID, a lot of those companies have not recovered yet. And we're like 4 years down the road. The stock market is trading at an all time high, but a lot of companies are still struggling to just recover their price from 2019.
But Mike, what would be the ideal scenario then? I mean, is it a mix of decent yield and growth, or should we just not mind the yield at all and sell those shares to have a cash reserve?
Well, again, several strategies work, right? Even someone that invests in ETFs would definitely not necessarily have the yield that they seek, but they could sell part of those ETF and that will work fine. Um, I'm in the camp of people not looking at the yield and just adjusting the cash reserve with what I need. Uh, you can build a portfolio at a 4% yield that is relatively safe, generating some good income, matching inflation, and have not much worry about where that portfolio goes. That is possible. Not easy, not like probably that from time to time you'll have to monitor a few stocks, but yes, that could work. And it would be the perfect scenario. Most of the time, you will find a few stocks like this, or they will be concentrated on a few sectors. So you will expose yourself to some sector exposure. So if there's a crisis in a specific industry, it's going to hurt. So I prefer to focus on great companies with great financial metrics and, of course, a solid narrative behind it. So therefore, I don't mind if my portfolio yields 2%, 3%, 4%, as long as I have quality inside. I'm good and I can just compensate with a cash reserve to complete for my withdrawal process.
So let's make things concrete. Which stock examples would illustrate your view and like quality stocks that you've been mentioning?
Well, you know what? I will share a complete retirement portfolio with Canadian and US stocks across all sectors. So, a well diversified, solid portfolio based on what we have discussed today, including the cash reserve tomorrow in our webinar. So,
Mm-hmm.
I know that there was like a mention in it during the podcast. The link will be in the show note as well. But the Dividend Income for Life webinar will be live tomorrow on the 28th. You can also watch the replay. So you just have to register and then we're going to send you the replay, or just subscribe to our newsletter across all I mean, in the show notes, across all our blogs or
Mm-hmm.
on YouTube, you'll find a link for that. And you'll get the entire retirement portfolio example there. It's going to be fun. In the meantime, I can say that if you look at my personal portfolio right now, even though I'm not about to retire, they would fit pretty much this illustration. So I have companies like Brookfield, Home Depot, Automatic Data Processing, National Bank, Royal Bank, Fortis, Alimentation Couche-Tard, Stantec. I mean, most of my companies in my portfolio have a lot of revenue growth, a lot of earnings growth, and of
Mm-hmm.
course, they are generous dividend increase for each of them and constantly. So companies that have a proven track record, they've been able to grow their dividend even during recession. And this is what I would call quality company. Now, if there's a high yield or a low yield, it's fun, but that doesn't matter. What matters is the quality behind it.
So, by the way, listeners, the dividendguyblog.com/webinar to save your spot for tomorrow. So, Mike, in the end, what's the problem with dividend investing? And is it possible to live solely on dividends?
I mean, it is possible if you have a very large portfolio, but if you need a 6, 7%, 8%, or like any high yield, it's going to be very tough. The dividend growth is a result of a good or a bad company. So when there's no dividend growth, chances are the business is struggling. When the
Mm-hmm.
company increases dividend every year, chances are it's doing well. I mean, it's just simple math, right? It's a consequence. So same thing for the yield. And I would like to discuss one last topic before we end, because I think it's going to illustrate the biggest problem where the dividend yield will blind a lot of investor. I had that discussion with a member, and he was saying, "Well, I've looked at UTG Reeves Utility Income Fund, so it's a closed-end fund," and he was like, that is an amazing fund, safest dividend on the planet, like very great yield on top of that, offering like over 6% yield right now. And when you look at the industry breakdown, it sounds very appealing. You look at it as like mostly utilities, so about like 60% of utilities. You have some communication services, industrial, some energy stocks, probably like pipelines, some real estate, and a little bit of material, but not too much. So the bulk of it is really, as the name says, utilities, like
Mm-hmm.
major businesses with stable business model, paying a recurrent dividend, a high yield. Everything matches, right? Like the story, once again, is really great. But then I
Mm-hmm.
was like, okay, so it's a safe dividend. I don't know that that close-end fund. So let's dig in a little bit further. And I went. It's actually kind of ironic, but the first graph you see when you go on UTG, so on the Reeves Utility Income Fund, is the graph of the annual distributions from 2004 to 2023. So a long history, very interesting. But what struck me there is between 2005 and 2010, we had once that the dividend increased. All the other times it was like equal or lower than the dividend in 2005. So if you retire in 2005 and you think that you can live off that dividend, well, in 2006, you got a cut. 2007 was a great year, but then a cut in 8, a cut in 2009, a cut in 2010. Not exactly the best case scenario.
Mm-hmm.
And then moving forward, another cut in 2012. And then from 2019 to 2023, the distribution increased by about 2%, which is not enough to cover inflation. So even in the
Right.
past 5 years, even if the distribution increased, your buying power was reduced. So retiring on this type of fund, which was great story, great business model, just utilities, super stable. When you look at the dividend, I mean, you got blinded by the yield, but in reality, it's far from being safe. And yes, it pays a very generous distribution, but it's unstable. And from every single time you have a cut, that means that you have to also cut something in your retirement. So it's maybe one year you're going to cut on your trip, and the other year you're going to cut on your grocery stores, on your grocery shoppings, or maybe you're going to cut on the gift you want to give to your children for their wedding. So this is not the type of investment I want. And keep in mind, between 2004 and 2023, even though we went through multiple market crashes, bear markets, and all of that, it was a very good time to be an investor. So again, if you focus on quality, you won't have to ask yourself those questions. But if you just focus on the yield, you may be seduced by a great story, but the numbers behind it are not going to be in your corner.
Mm-hmm. Well, thank you, Mike, for this educational episode. Listeners, remember that dividend yield does not matter much. What matters is dividend growth investing. To review your portfolio according to the DSR strategy, download your free portfolio workbook at thedividendguyblog.com/workbook, or make sure to save your spot for the Dividend Income for Life webinar that we will hold tomorrow at thedividendguyblog.com/webinar. For the show notes and related content, visit thedividendguyblog.com/203. Never miss an episode again, and help us grow by hitting the subscribe button and sharing the show. Until next week, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.